Everybody, welcome back. That was an interesting month, wasn't it? So, a lot going on, and one of the major focus points was what the central banks have been saying and how that leaves us, really. So, with most of them more or less done, letting us know what they're going to do, if anything, I think it's worth having a look back at exactly where we are now. All the central banks, to be honest, pushed back on the amount of rate cuts the markets were pricing. So basically, the markets have got ahead of the central banks to some degree, which slightly annoys central banks. They like to have control of the bond markets, particularly. Obviously, excluded from that is the Bank of Japan in Japan and the PBOC, which is out of China. They're obviously on a completely different path at the moment. But the rest of the G10 central banks have given us a fairly good inclination that they're not going to do anything just yet. They all held rates as they were. But it was the statements that I think people sort of were really waiting for. And they acknowledged that while inflation is falling, it really isn't there or anywhere near target at the moment. And this last mile, if you like, may be harder to achieve than the first positive news that we've had to date. So, I think what they're trying to do is walk market back. They're all saying that they need more economic data. That means what we call data dependent central banks now. And so, volatility is going to be around a lot of the tier one data. So the central bank's concerns are there's a few of them. They're very, very worried about cutting interest rates too soon. They feel that if they cut rates too soon, there's a danger that inflation could come back. And let's face it, in the US economy right now, the economic data is not only resilient, it's actually quite strong. So this is a bit of a concern going forward, particularly for the Fed. But all central banks have had historical moments when they've moved policy too early and been found to have quite a reduction in their reputations. So, reputations count a lot for central banks, and so that's one of the problems. The other issue with issues around inflation is that geopolitical issues in Ukraine, the Middle East, and potentially Asia, which can all impact supply lines. In fact, we've actually seen some evidence of that in the data we've had just recently, particularly out of the US, where some of the goods inflation has actually gone higher. Consumer spending is still resilient, especially in the US. And with a strong consumer, which is such a big part of the economy, there is a danger here that with rising stock markets, high confidence from consumers that keep spending, that inflation could return. So we need to be very careful. The chart on the right here shows you roughly where we are at the moment and a few forecasts into the grey area there. They're the forecasts of some of these banks. So they are forecasting to come down quite steeply. But for instance, in the US, we've got about five cuts still priced into the market. And yet the Fed is talking more about three potentially this year. Someone's going to be wrong. I think if we flip over to Japan and China, I think obviously these are quite different. The BOJ is the yellow line on the chart on the right here, as you can see. They've maintained their ultra loose monetary policy. I think we could see more of that from China, but there is a lot of talk about Japan ending this loose monetary policy by raising rates at some point. But again, they need the data to come through to support that view. So, they pushed back on market pricing of a change policy and a move to small hikes. So I think what's going on is the market saying, okay, they're committed to hiking, but when? And again, the markets keep getting this timing wrong. So again, the Bank of Japan is still very data dependent going forward on that. The PBOC are the only ones adding liquidity and cutting the reserve ratio for banks. That means the banks have more cash allocated to them that they can lend to try and boost the economy. At the moment, it's not really getting through. But the PBOC haven't cut interest rates because inflation is still rather weak, but they're worried about sparking another or further debt issue. So I think they've been reluctant to move in a direct economic boost that we've seen in the past due to this debt issue. And what they're trying to do is to juice the stock markets. And the stock markets had, restrictions on selling, trying to get the market up to sort of create some confidence in China. It'll be interesting to see if that doesn't work. But this is another way of dealing with policy. But as you can see on the chart on the right here, China's deflation problems persist. And I think realistically, there's a danger that they're not going to cure this by moving the stock market up 10%. But new inflation update does come on Thursday, the 8th of February. That is tomorrow, if you're watching this live. And I think the market's going to be looking at this data quite closely. So keep an eye on that. Looking forward, I think it's really important that we understand a few things here. For instance, the OECD has suggested that it sees moderate growth persisting, but look at the what I would call exceptionalism of the US. This is the US outstanding above all others. This is them sitting head and shoulders above the likes of the Euro area, Germany and France in particular, Japan still down there. And you can see the UK down there, not forecast to do brilliantly, but outperforming a couple like Germany. So there are still this idea that these economies are not moving in lockstep. So just because the Fed decides not to move, does that make that the right policy for the ECB and the Bank of England? I'm not sure it does. So whilst we've got a strong US market economy, we've got a very weak European economy at the moment, and the UK for me is somewhere in between of those two. At present, that's what the data suggests, and some of that data is a little bit backward looking. So the central banks will have to react differently, which creates opportunities because, as you know, as they move rates, interest rates, then yield differentials change, currencies move, and it can actually impact stocks as well. But these differences will throw up trading opportunities in different markets outside of FX as well, commodities, and even possibly stocks. So let's have a look at some examples of each.